it's Daniel Kaminsky, and I want to give you a quick rundown of the private foundation. This is for you and anybody that you want to share it with. As the name implies, this is the quick version. But the reason I call it a living legacy is because I believe you don't have to die to leave a legacy. You can do it while you're living, and whether you want to or not, you're going to be leaving a legacy. So you might as well be intentional about it. And I do believe that the private foundation is one of the best ways to bring structure to that. So I'm going to go through quickly what is a private family foundation. It's a type of private foundation that's set up by a family and funded with family assets. A corporation or a company can also set up a foundation. I'll send you a separate video with regards to that. But basically, you're getting a tax exemption under the 501c3. I like to think of this as your personal 501c3 or your own personal charity. There's over 100,000 private foundations in the country. They collectively have $1.5 trillion in total assets and give $100 billion on an annual basis. Most people, when they think of a foundation, they think of the multi-hundred millionaires and billionaires, which, they're pretty common, of the Bill and Melinda Gates Foundation, the Rockefeller Foundation, Mellon Foundation, the Hiltons, Ford, you name it. Actually, 83% of the families on the Forbes 400 list have a private family foundation. And the reason for that is control and investment flexibility, which we'll get into. But the thing I usually tell people first is that the majority of foundations have assets of less than $1 million. 67% of them have less than $1 million. And if you take a look here and wrap in the $1 million to $10 million, the vast majority have assets of under $10 million. Most people are familiar with typical giving, which is you write a check or give cash or something to a charity, and for that you get a tax deduction. When you have a private family foundation, all we're doing is adding the second layer here of creating your own entity that has tax exemption, and for donating to it, you still get that same tax deduction. And then the idea is to grow that in the tax-free environment and then eventually make grants to other public charities. Your role in this is three things: give, grow, and grant. So giving dollars or assets will get you a tax deduction, grow those in the tax-free world, and then give them out. Here's a quick rundown of a charitable vehicle comparison. So direct gifts, donor advised funds, and private foundations. You can pause it here if you'd like to take a look at those differences, but basically the idea is that the foundation gives you the most control and flexibility, which is why it is considered the gold standard of charitable vehicles. I like to think of it as the Cookie Monster of charitable vehicles because you can quite literally donate anything that you can get valued to it. So cash, stocks, bonds, mutual funds, real estate, artwork, cryptocurrency, other assets. Angelina Jolie had her wedding photos valued and donated to a foundation. So I know we talked about commodities. You can absolutely contribute those as well. There are income tax deduction limits. So it's 30% for cash, 20% for other assets, but the main difference being for publicly traded securities, it's 20% at the fair market value, whereas for crypto, real estate, artwork, things like that, it is 20% valued at the cost or basis of the asset. There is a 5-year carry forward, so if you give over the limit, you won't lose the deduction. It'll carry forward to future years. So for somebody who makes $1 million, they could contribute up to $300,000. That would reduce their AGI to $700,000, and that would, if they lived in California or New York, they would have a combined tax rate of about 45%. So that would save them $135,000 in taxes. So to talk about that carry forward, if they donated $400,000, they would still get that $300,000 deduction this year, and then $100,000 would carry forward to the next year. So that is the personal income tax deduction. And avoiding capital gains tax. So Mark Zuckerberg, here's a great example of, in 2017, he donated $2 billion of Facebook stock to his foundation. This is actually a screenshot from his foundation filing. And you can see that $2 billion here, and the basis in that stock was $1,173. So if he would have sold this, he would have had a huge capital gain because it was basically a zero basis stock. So we look at those numbers. $2 billion at a 20% capital gains rate in a California 13% rate. His tax due would have been $660 million if he would have sold that in his personal name. So instead, he transferred it over to the Chan Zuckerberg Initiative. He paid zero capital gains tax on that. He got a $2 billion income tax deduction on his own personal taxes, and he still gets to maintain the $2 billion worth of Facebook stock within his foundation, where he can either liquidate and reinvest or maintain the asset. For estate tax exemption, Warren Buffett's the leader in this, and he's basically stated that he's leaving 99% of his estate to philanthropic usages, and he's already donated over $50 billion to the Bill and Melinda Gates Foundation. And he does that because he understands that his estate can only go three places. It's either going to go to his heirs, to the government in the form of taxes, or to charity. And for him, his heirs are already taken care of. So that leaves him two options, to either taxation or to charity. And he's definitely chosen the charitable option. There is tax-free growth, so there's no income tax on investments, interest, dividends, capital gains, or any other income. There is a 1.39% excise tax on investment income, but it's basically negligible. And if you do have property within the foundation, it can have the property tax exempted because it's a 501c3. These are some unique ways that you can get a tax deduction by using a foundation. So making grants to individuals through scholarships or disaster relief, paying staff salaries, including family, paying expenses to run a grant making program, making international giving through other charities or NGOs, all ways that technically you can use tax deductible dollars that you wouldn't have been able to personally. This is something that I've coined, what I call a sustainable giving system. And what I mean by that is, for example, one of my favorite charities, Charity Water. If you give $10,000 a year to them and you had a bad year or you die, that donation disappears. So then Charity Water must find another donor to replace your annual gift. However, if we do something like a foundation, we can establish a sustainable giving system by contributing $10,000 to the foundation at a 7% growth rate, tax-free, over 10 years. We will get to the point where the annual investment income is kicking off $10,000 per year. So whether I'm here or not, or another dollar goes into the system or not, that $10,000 can continue to be given to Charity Water, knowing that every additional dollar I put into that system will increase the amount of opportunity to give on an annual basis. Or on the other hand, if I could contribute $142,000, if we just round up to $150,000 worth of assets to the foundation, growing at 7%, that would also kick off $10,000 per year. A lasting family legacy. This is where the concept of bringing structure to family mission, vision, values, successorship, stewardship comes into play, because as we know, the majority of wealth transfers fail. So the foundation can be a great breeding ground to have conversations about how to run a business, budgeting, being generous, giving money away, and planning, and all kinds of different things in that regard. And so, as the name implies, a private family foundation, just like I was saying, it can be a breeding ground for family values, spending, saving, investing, and philanthropy. You can have a board of directors. You can do family retreats. You can do site visits. You could technically travel all over the world if you had enough resources to do so, and as long as it had a charitable intent. So that's the quick and dirty version of the foundation. Thing to keep in mind, whether you're an individual, family, or corporation, there's an opportunity to set this up and basically have it as an entity that's there, that that you have an opportunity to either transfer cash or other assets and get a tax deduction for doing so, and be able to grow those assets, maintain control of them, and then eventually give from them. So hope that was helpful. And as always, if you ever have any questions, please don't hesitate to reach out.